you're very largely a domestic consumption story, and there are so many people who, even though we've elevated them from below the poverty line, but there are so many people who are still not consuming as much as people consume in even the semi-developed markets. Forget the developed markets. So there's a huge runway for growth that is available to us as we include more and more people, as more and more people sponsor. Consumption is going to go up, savings are going to go up, and all of these things transform an economy, which is at our stage, at the stage at which we are right now. There's a massive transformation that takes place in the manner in which we consume, in the manner in which we save, manner in which we invest.
Hi there, welcome to Market Pillars Uncovered. This is an educational series and we keep you abreast with all of the latest happenings within the financial market space with some of the top industry voices on their outlook. Today we have the pleasure of having with us in our studios Mr. Rajiv Shastri. He's the founder and CEO of GoldStandard Wealth, which is a SEBI-registered portfolio management services firm. In fact, he comes with over 30 years of experience, having worked with renowned names in the past, such as HDFC Mutual Fund, as well as NJ Wealth Advisors. And today, he'll open up talking about his outlook on the Indian economy, what's unusual about GoldStandard's unique approach, the outlook for the markets, and so much more. So let's dive straight in. Thank you so much for taking time out and being with us today.
It's a delight to be here. Thank you so much for having me.
So let's get straight into it. The fact that you're a perennial bull, and I'm sure the Indian economy is going in all the right directions despite all the headlines that we've been bombarded with of late. So what's the view for India in 2030?
You see, India's very largely a domestic consumption story, and there are so many people who, even though we've elevated them from below the poverty line, but there are so many people who are still not consuming as much as people consume in even the semi-developed markets. Forget the developed markets. So there's a huge runway for growth that is available to us as we include more and more people, as more and more people sponsor. Consumption is going to go up, savings are going to go up, and all of these things transform an economy, which is at our stage, at the stage at which we are right now. There's a massive transformation that takes place in the manner in which we consume, in the manner in which we save, manner in which we invest. And, all of those things make me very, very bullish about the Indian economy.
Absolutely. And like you said, the runway for growth looks very promising.
Absolutely.
So in light of that, I'm sure you've identified a number of sectors that have stood the test of time and still have the potential to do well. Which are they?
I'll talk about my favorite sector, which is asset management and associated fields with asset management. Asset management has a very unique characteristic. It not only benefits from incremental savings, which we expect to increase as time passes, but it also benefits from market returns. So the assets under management appreciate because of market returns as well as fresh inflows. That has helped the asset management industry grow at a compounded rate of maybe 20-24% over the last few years. And I expect that to continue. Even though market returns will taper off, we are not going to get, consistently double-digit returns as inflation comes down, as the economy matures. Obviously, people will have to get a little used to lower returns. But this is absolutely by far my favorite industry. I think if anyone wants to invest or start something new, this is the place to be.
Oh wow, so you're very clear cut about that. Would you widen it to some other industries or, like to share any other areas?
There's, sunrise sectors like, AI. I'm a very, very big AI bull, and, I like talking to Indian AI founders and, understanding what they're trying to do. I support a few of them. And, I would love to get more and more involved on the AI side because I don't see, unlike a lot of people who see a threat from AI, I don't see a threat. What happens is, like for example, there is, an animator, right? Before AI, what an animator could do, I couldn't do. Now with AI, I can do what an animator can do, right? And people feel that is going to cost them their job. But imagine what an expert can do with AI.
Exactly.
Okay, so what I see is that the quality of work in general is going to get elevated over a period of time, and it's, we are going to have a better quality of life. We are going to have better, quality work, that, better quality output that comes from, almost every field.
Yes.
Whether it's creative, whether it's, functional, whether it's operational, every field, the quality of work is going to increase. And that excites me, because that, brings in an efficiency which we haven't seen.
Absolutely. I was speaking with Rajan Anandan just a short while ago, and he said that it's not the job that will get replaced, it's the task that will get replaced. So you just need to reskill yourself and get AI tooled up to move with the times.
Move with the times, absolutely. And that's what I keep on telling my team, that you're not going to be replaced by AI. You're going to be replaced by somebody who knows how to use AI. So, if you know how to use AI, if you can upskill yourself, you have, many, many years of growth ahead.
The world's your oyster.
Absolutely.
So, when you're bullish on an industry, how do you determine what the right approach is? Is it go in blind with large caps? Is it take exposure to mid and large caps, throw in a little bit of small caps, or do you have a very specific approach?
I prefer to look at companies, individually, rather than go in by capitalization or generalizations. I prefer to look at companies and understand businesses, in depth before I make up my mind whether to invest in them or not. All of these capitalization segments have their advantages and disadvantages. So
do you have a criteria or parameters that you look at even when you're looking at an individual company?
Most of the companies that that are coming across right now, I mean, at least most of the unlisted companies that are coming across. As a firm, we don't invest in unlisted companies, but most of the unlisted companies are, cash flow negative. So basically, they're making losses and all of that. What you look at that point of time is unit economics, and whether there is positive unit economics. That means with growth, profits can come. If unit economics are negative, which we have seen in a lot of companies in the past, which means that as you grow, losses increase. So that's a bit of a problem. With listed companies, I think data is, very easily available and very widely available. And it's high quality data. So what we look at is, typically what a quality investor would look for is high levels of ROE, high levels of, dividend-paying companies. We like dividend-paying companies, and we like companies which have low levels of debt, appropriate levels of debt, not zero, because there's enough room for debt in, what are a lot of zero debt companies today. There's room for debt, which will increase the return on equity, but we like companies with an appropriate level of debt.
Fair. I wanted to understand as well, you've got a lot of expertise, and now at GoldStandard, can you tell us a little bit more about what is so unique? Because you described it as fairly unique. So tell us how it works.
So the idea of GoldStandard started around 5 years ago in 2000, when we had COVID, and simultaneously there was a tightening of the regulations around portfolio management services. SEBI's approach to portfolio management services has been getting more and more, I would say more and more robust. They want a more robust infrastructure to take care of people's money, because PMSs, like mutual funds and AIFs, take custody of client assets. So they want a structure which is robust, which will outlast an individual, and will basically ensure that the client money is taken care of, irrespective of what happens to an individual portfolio manager. So SEBI started tightening the regulations, but portfolio management as an industry has been a very individual industry. Okay, there are experts in the market who people trust, and they want the experts to manage their money. Not every expert has the wherewithal to create an institution, right? So as SEBI's requirements tightened, a lot of these people started getting disadvantaged and losing out on being able to start their own firms. The market started losing out on their talent. Okay, and many of them got pushed into unregulated and informal portfolio management kind of arrangements, which then in turn became a problem for SEBI as well, because there are, hundreds and thousands of these people, and they're unregulated. So every once in a while there's a complaint, and then SEBI has to investigate, and then the whole process starts again. So what we did was to bridge the gap between these two. We have a portfolio manager's license. We have the infrastructure that is required. We have the institution that is required, the institutional framework. We employ experts, and launch strategies for these experts. Okay, so basically every expert we employ, we do a thorough vetting of the expert and employ them, and we launch a strategy for them, right? And they manage that strategy for their clients, right? So as such, it becomes kind of a platform, but it's not really a platform because we are the regulated entity. We are not, completely unregulated, completely free form, completely free for all type of place. It's a very heavily regulated entity, and we take responsibility for everything that happens on the platform. So that's a very, very big thing.
Understood.
And to tackle the risk that comes along with that, we have a very elaborate risk management system that we've developed. That's in-house. And we've developed that risk management system over the last year or so. And it just basically manages all the transaction risk, all the market abuse risk that we may face as a result of having many portfolio managers. It tackles that centrally. And, that's why we are able to do what, most people, we are not doing anything that anyone else can't do.
Got it. Okay.
It's just a very different approach to it.
Yeah.
That's all.
So you've given us a sense as to what PMS is all about as an industry, what you guys at GoldStandard Wealth are doing. But how do you see the industry for PMS growing in India?
So to a large extent, because of the factors that I mentioned, the growth of the PMS industry has been kind of held back. It's been held back by, the absence of new talent coming in. It's been held back by, the manner in which expenses have risen, regulatory expenses have risen. So a lot of existing portfolio managers have gotten disadvantaged. And, all of this has led to a kind of a slower rate of growth as compared to, let's say, mutual funds or AIFs. All of this is changing. I'm also on the board of APME, which is the Association of Portfolio Managers in India. And we found SEBI to be very, very responsive. In fact, we met the chairman, a couple of days ago. And we found him to be very, very responsive for the, about the needs of the industry. And we expect a lot of change to come in. And we expect the PMS industry to actually grow at a much, much faster rate than it has in the past and catch up with the other industries that are there.
So given that it's looking very optimistic for growth for the PMS industry, how does an individual decide whether PMS is the right option for them and then selecting the right service provider?
Right. Portfolio management is positioned very uniquely as compared to all other complete asset management structures. So in a mutual fund, you have a pooled asset base. So what happens is people invest money into a pooled vehicle, into a single vehicle, and that vehicle invests in a portfolio. Every investor in a mutual fund gets the same portfolio, right, of the scheme that they've invested in. The same thing goes for AIF. Right? Now, when you reach a certain level, it becomes really very difficult for people to either analyze which mutual fund they should invest in, B, analyze which AIFs they should invest in, analyze what stocks they should invest in, analyze whether they should have an exposure to commodities or not. So I see mutual funds as, the peak asset allocator. If an investor wants to invest money, they should first contact a portfolio manager and allow the portfolio manager to help them decide how much they should invest in mutual funds, whether they should invest in an AIF, whether they should invest in equities, whether they should invest in gold, silver, ETFs, whatever. Allow the portfolio manager to assist them. And the barrier is not that high. If you actually go to see, 50 lakhs used to be a huge amount 5 years ago. Right? But over time, 50 lakhs has become more and more approachable. A lot more people have 50 lakh worth of investments. Right? But they're going about it pretty much unguided. Right? And here, the structure is such that the portfolio manager earns fees only from the client. They do not earn fees any from the asset side at all, only from the client side. So the interests are completely aligned. So the first port of call for anyone who has 50 lakhs worth of savings or investments has to be a portfolio manager, because a portfolio manager can help them allocate to mutual funds, equities, commodities, everything, design a beautiful portfolio for them so that they can and this customization is what is missing in other industries.
Got it. Can you help us better understand your Freedom series and the Prudence products?
So we have various levels of equity participation in our in the series that we have. We have a total of 5 series of products. So at one end is the Prudence series, which does not invest in listed equity at all. Okay, so it invests in mutual funds, ETFs, debt instruments, REITs, InvITs, commodity ETFs, whatever. Everything except for listed equity. At the other extreme is the Freedom Series, which can invest up to 100% in listed equity, right? And then we have 25, 50, and 75% slabs in between.
Right.
So these are the two ends of the of the spectrum, and you have three of them in the middle.
Okay.
And it depends on what a portfolio manager really wants to do. So there are many portfolio managers who just want to manage a fund of funds. Okay, for them the Prudent Series works best because they don't have the skill set, let's say, to identify stocks, but they know how to analyze mutual funds.
Yeah. So tell us about how you got into this industry and what your beginnings were and what have led you to the turning points and where you are today.
First off, I've been incredibly lucky. We came into the industry at the right time. The industry was growing at a stupendous pace, and that helped me grow with the industry. It's not as if a lot of us who joined the industry at that point of time have grown very well, and I have a lot of my peers who are CEOs and founders and heads of businesses at various places. The interest in the industry came from conversations with my uncle who used to live in the US, and he kind of enlightened me about mutual funds. And this was just when I was completing my CA. This was about 1994. And that's the time when, I got very enthusiastic about mutual funds and I wanted to build a career in them. My innate interest, my core interest is in fixed income, in debt, and in economics.
Right.
So I have done a lot of, I used to manage money. I used to head fixed income investments for HDFC Mutual Fund.
Yes.
And so managed a lot of money. But then I moved on to more general management roles over a period of time. Again, very lucky to to get those roles offered, and I've treated my career more or less like an adventure.
Okay.
It's always, let's see where this takes me, right? Rather than have like the structured path. Okay, now I want to do this and this and this. I've not had a structured career at all. There have been enough ups and downs.
Yeah.
There have been long periods of not having a job. There have been very happy periods of doing wonderful work. So it's been fantastic. I've loved every bit of it.
No regrets at all.
Not at all.
So is adventure something that you enjoy in your free time as well? What keeps you busy?
Right now it's work.
Okay, but when you're not working is what I mean.
There's seldom a time when I'm not working. Honestly, when I'm not working, I'm with family.
Okay.
But whenever my family is together, both my sons are grown up. So, having them together is a blessing. But whenever it's family together, it's their time, and the rest of it is work.
Okay.
Though adventure on at a personal level is something I find to be a very Western concept, honestly.
Okay.
Because having lived in Bombay, having started at very humble beginnings, I've always stayed in Andheri West. Having started at 6,000 rupees a month salary, I used to travel by train. And for me, at that point of time, adventure was catching a Virar fast.
It still is.
And getting off at Andheri from a Virar fast. By God, that is something that...
you need your skill, agility, speed, everything.
And that's risk. That's an adventure. I wouldn't go bungee jumping. I would just, go to Churchgate.
Okay, lovely chatting with you, Raji. Thank you so much for telling us so much about GoldStandard Wealth, what you guys are doing, the PMS industry as a whole, and of course, your outlook on India and where it stands. And it's good to know that you are a perennial bull. Thank you.
Thank you so much for having me. It's a pleasure being here.
Well, that brings us to the end of Market Pillars Uncovered. Do remember to like, share, and subscribe, and follow Money TV for lots more interesting interviews with top market experts. In the meantime, invest smart and stay informed.